is Jan Roos. Jan is an attorney and the founder of Outside Legal. He was a former partner at Witten Law. And I should have put it on here. Jan is a member of the StartupSac board. So thank you, Jan, for serving your community that way. Yeah. And this session is brought to you by our sponsor, Witten Law. And I'm going to go ahead and invite Jan to share his screen, and we'll get started. If you have questions during the presentation, during the presentation, I'd like for you to type them in the chat, and then I will find a good sort of breaking spot and ask Jan your question. But there's also going to be plenty of room for asking questions after the presentation. So I just request that you go ahead and put yourself on mute for this part of the presentation, and just if you got questions, put them in the chat. So go ahead and take it away, Jan.
Thanks, Laura. And hi, everyone. Thanks for joining today. Laura already introduced me, so I'll just say hello here. As she mentioned, I'm a very recent former partner of Witten Law, and I have just recently decided to move on a little bit to pursue a few different projects, one of which is Outside.legal, which is in its very earliest stages, but you can go and at least check out the initial homepage at Outside.legal for that and get a sense of some of the connection opportunities we're trying to establish for startups, but also just for single founder entrepreneurs and companies. The idea really is to provide a little more robust network to connect companies with attorneys who kind of get it. And one thing I've realized over the years in serving so many startups and being their attorney, but also just meeting the founders and startups at events, is that it can be really daunting and really difficult to find qualified counsel who understand your company and understand what you're trying to do and have a technical background, or just sort of can speak the same language that you're speaking, not talk above or around you as an attorney. And so through Outside Legal, we're trying to create a better database and a better connection point to bring those services to startups and curate the connection process a little. So just a fun side project. Today, we're going to be talking about investment essentials for startup founders. And before jumping into the slides even further, the kind of admonition that I'll give here is that many of the concepts we're going to cover are far bigger than what could be covered in a single presentation. I'm sure that that's understood. We're going to talk about some very complex concepts at a ultra high level, 60,000 foot level, not even 30,000 feet. And many of these topics they take on a life of their own, depending on your unique situation, your unique scenario. And this is not so much a legal admonition as it is just a practical one, which is no two startups are the same, no two founders are the same. Everyone's goals are different. Everyone's roadmap, product roadmap, company roadmap, team build roadmap, they're all different. And your ability to raise funds, your ability to successfully grow your company can never follow just a single rubric. Some of the most successful companies in the world, and certainly those in Silicon Valley and beyond that you would consider sort of the startup unicorns, they'll be the first to tell you that the investment game is not exactly what they thought it would be, and that they learned lessons along the way. They had some successes, some failures, and usually the roadmap only starts to become clear far later on down the line than anyone would like to think. So that's the kind of early stage caveat that I'll point out here. And we're going to cover a number of really important concepts. And I think my goal for a presentation like this is to get founders and those that are on the call just a bit more acquainted with terminology and investment concepts, and a broader understanding of what they can expect to hear and see if they go out and actually want to raise investment and outside capital, or if they're just trying to, frankly, come across as a little more sophisticated in their pitches or in the startup community generally. So with that in mind, please do feel free to submit questions in the chat. I think Laura's going to be sort of our Q&A person for that to handle those. And I'm a fan of dialogue, and I don't have any problem with interruptions or anything, but I think we're going to maybe try to keep some of those to the end, and we can go back on slides if we need to. And otherwise, I want to focus more on that and make sure that folks are getting their questions answered. So without further ado, let's dive in a little bit. Again, I'm Jan Roos, that's me. This is the general roadmap that we're going to follow a little bit here for the slides. We're going to talk about the general types of funding that are typically available to startups, and there are some exceptions and some alternative routes to funding that we can also maybe talk about. We're going to talk about the big ones though. And then we will discuss securities transactions generally. That's not like the protection security, that is as in the definition, the legally defined definition of security, which derives from almost 100 years of legalese and case law and statutory interpretations and our very own Securities and Exchange Commission, the SEC. And it's very, very important. And it's probably the least understood aspect of seeking investment funds for startups and the restrictions and the obligations that underlie that transaction. We're then going to talk a little bit about reading term sheets, because if you've ever sought to raise outside capital, either the investors that are interested in working with you or somebody somewhere along the line is going to bring up the concept of a term sheet. So what are they? What do they typically include? And what do you need to look out for? Going beyond the term sheet, hey, congratulations, somebody actually wants to invest in you, and the terms of that investment at a high level have been more or less, accepted. You've got a letter of intent or something similar to move on to. So now you get into due diligence of some type, some form. It could be very short due diligence, depending on the health and life of your company, or it could be much more drawn out. And I will go into some detail and specifics about what that process can look like depending on the investment group. And then finally, good job. You've actually received investment, which is, post due diligence, they've decided that you're not going to be an absolute disaster and that your idea, your company is worthwhile, your team is great, and they believe in it and they want to support it. But that's not the end of the game, right? They write a check, maybe not the entire thing all up front, but you're now living with them. So you've got the investors sleeping on your proverbial couch. What's that like, and what do you need to be aware of? So that's the roadmap. Again, starting out with sort of types of funding. These are the predominant four categories that we typically see and that we typically tend to work through, not only as attorneys, but on behalf of startups. Debt financing, that includes, I guess, what I would call more traditional business financing. So banks, credit unions, the SBA, things like that. Usually terms of investment that are structured more like a loan. And we'll talk about some of the specific instruments used, but usually along the lines of a grant or a loan. In the case of a grant, and we've seen a lot of those come across because of COVID, grant opportunities for small businesses, usually those don't need to be paid back if you meet certain criteria, whereas loans almost always do, with varying terms of payback. So usually some rate of interest, sometimes not, and potentially other rights that come along with the loan documents. And then the programmatic component of debt financing, lots of different programs out there, accelerator, incubator type programs, and others that programmatically provide loans to small businesses. Again, the SBA is sort of in that realm as well. And then the rich uncle concept, of course, if you just have a wealthy benefactor, family or not, and you're just looking to raise, say, a seed round, depending on the total amount you're looking to raise, sort of a friends and family concept is certainly very popular. But just because the investor may feel familiar doesn't mean that you need to be less formal in how you approach that concept. In fact, that's a big pitfall we're going to talk about later. The next stage, and the one that a lot of startups, I think, plan to target when they start building their company, if they're thinking of outside investment, ranges from traditional angel funding, which either can take the form of a group or conglomerate angel funding, or more traditional venture capital, where you have a number of private investors, usually operating as limited partners within a fund. And the venture capital group is operating as a general partner of that fund, meaning they are managing and directing the investor funds into particular investments, usually thematic. So a fund may focus on pure SaaS and software plays, or they may be focused on transportation. Or energy and green energy and renewables, things like that. So usually there's kind of a theme that allows the fund to create a narrated thesis, kind of an ethos for investment, so that they're comparing apples to apples with companies they're looking to invest in. And some VC groups and even private equity groups are operating multiple funds underneath them that are focused on those different industry areas. Strategic investment is a favorite area of mine, actually, because it's one that I think is probably too often overlooked and not considered a very valuable opportunity for startups. These could include joint ventures. So say you're a startup working in a particular industry or market sector, and you have some competitors maybe, but more than competitors, you have companies that are already in the space doing something a bit different, and what you offer is actually supportive of what they do. You're not a competitor, it's a corollary service or something. And because they are much bigger than you, there may be an opportunity to form a joint venture or some sort of strategic partnership that actually involves both a joint provision of services, but also some flow of capital from them to you. And in exchange, they may take some form of equity or a warrant or an opportunity to invest later, or it may be a revenue share type agreement. Same thing with the corporate VC structure. I find these to be really interesting investment opportunities because unlike some of the more traditional debt financing or equity investments, these often tend to be creatures of contract. And so for a startup, I like contracts, and you've got a lot of opportunity to create custom and creative forms of investment and capital inflow to support your operations. And the sky's the limit in terms of coming up with how you value that investment coming in. So again, on the joint venture side, it could be as simple as a revenue share, or it could be something bigger than that and a joint ownership opportunity. And then the final, main category of investment that certainly we want to focus on and be aware of, and I would still say that it's the minority of startups that are interested in pre-sale and Reg CF rounds, but crowdfunding is a big deal. Certainly, we've got a lot of great companies in the region that are still looking to crowdfund and raise either crowd equity rounds or some alternative version, basically, of crowd raises. And there's a lot to unpack there. The good thing about them is Reg CF and a number of other statutory changes over recent years have made it far more possible to raise crowd-funded rounds and help get your company off the ground. They tend to work a little more for companies creating an actual product, something physical. Think of your typical Kickstarter company, and I think many of them tend to do well when they're creating a physical product. It's a great idea. You can go raise and market all at the same time, get a ton of support, build that marketing campaign around it, and hopefully raise enough funds to kick off maybe your first manufacturing round or something like that. So a few pitfalls there as well, but we'll talk about those a little bit more. All right. So again, we talked about the main types. We're going to focus on securities transactions a bit, and I want to talk through some of the complex aspects of securities transactions that we're not going to be able to dive through every element of, but at least you'll be able to come out of this saying, all right, I've heard of this. I know what a security is. I know that one of my goals would be that for you to come out of this meeting and this type of office hour call to realize how serious these concepts and these conversations are. And I want every startup founder to come away from these things understanding that they should never, really be just going out there and saying, hey, here's who we are. We have a great idea and we're open for investors. Come talk to us. That's typically a big no-no. That's typically considered a general solicitation under SEC guidelines. And so we want to move away from the, hey, I don't even know how to raise money, and educate that concept. We want to move away from the, all we know is we need money, who's got some, bring it here concept. And we want to create a little more targeted, a little more strategic approach to investment for your startup. So first thing we have to talk about is what a security is. And that definition, still to this day, really is governed by and derives from this old Supreme Court case, commonly known as Howey. It's the Howey definition. So a security, from Howey, a security is an investment contract for purposes of the Securities Act, It means a contract, transaction, or scheme whereby a person invests his or her money in a common enterprise and is led to expect profits solely from the efforts of the promoter or a third party. Okay, so a few defined terms in there, but let's unpack that a little bit. The general idea here is that a security is any instrument, so a written instrument, and we're going to talk about some of those, but it's safe note, convertible note, and certainly any written offer for equity. That could be, if you're an LLC, it could be membership interest. If you're a corporation, it's going to be shares, common or preferred. And in any instance where you are entering into an agreement with somebody who, where the agreement basically says that someone is going to give money or capital or some other thing of value, and in exchange for that, they are expecting not only a return of that money or capital, but they're expecting profits based on that. That's a security. The contract itself, whether it's written or not, the contract is the security. And as soon as you dive into this realm, where you are offering something to an investor and the investor is expecting profit based on your efforts or the efforts of a third party, in exchange for that, you're entering the world of SEC regulation and guidance. And it's a scary world. And even for attorneys practicing in this space, there are tons of pitfalls. But we can navigate through them a bit because there are some well-worn instruments that have navigated these complex paths and create for us some understoods, some principles of investment that we know well and that we can generally rely on in seeking investment for startups. So, going back a little bit, thinking about debt instruments, that concept of debt typically meaning an instrument, a securities instrument that usually is expected to either be paid back, or in the case, for example, of convertible notes, might be something that either could be paid back or convert into true company equity down the line. So the traditional instruments that we see are promissory notes, which is a fancy way of essentially saying a loan. So a promissory note might be me, I think that your company's up to something interesting. I want to support it. I'm not sure that I care to be an actual equity holder down the line, but I'm willing to write a check to support development and growth. So I loan the company $10,000 for some initial development work at a very small interest rate, and hopefully that gets you up and running. And the company agrees to pay it back within a year or 2 years or something like that. That's a promissory note. Convertible note adds the additional element of conversion. And it's essentially a promissory note saying, same $10,000, I'm going to sort of loan it to your company, but we have the election to either receive payback on that note, or if the company is going to go and actually succeed and raise additional funds down the line, the convertible note gives the investor an opportunity to convert that investment into true equity. Usually they're doing so in line with other investors that come in a subsequent round, but there's often what's called a discount or some other perk for investment offered to the very early stage investor. So for example, if I loan that $10,000 across and in 6 months, the company's actually ready to go raise $100,000 at a particular valuation, usually my convertible note will say, ooh, I get to contribute my $10,000 already loaned as part of that investment raise, and I get a discount on that. So my $10,000 is actually worth more than a new investor's $10,000 are because I have this discount built into it. And what that's really doing is incentivizing early stage investment and letting and also appreciating those early stage investors to the extent that you end up raising a subsequent round. Safe notes are essentially a creature of Silicon Valley that were born out of the accelerator world and are a very streamlined convertible note concept. They work really well for early stage companies that are sort of following the model, the Silicon Valley model, which is kind of Delaware C Corp, no major complex custom changes to that, just a really straightforward startup. They work really well for software companies, and they're basically telling an investor that knows the traditional startup investment game well. They like safe notes because they're predictable. They know exactly what they're getting out of them. They give the investors particular rights. Again, it still gives an opportunity for payback, treated like a loan, but it gives a very simple conversion opportunity down the line with subsequent investment rounds as well. Moving beyond the super early stage kind of note concept, we move into just pure stock. So again, say you form your corporation, if that's the direction you're going, and you have usually authorized at a minimum a class of common stock shares as part of your corporation. You need to do that actually at the point of formation. So a lot of companies will authorize 10 million shares when they form their corporation. Without separating that class of shares out specifically, they're all just common stock. Where preferred stock comes in and becomes interesting, and this is a concept that often gets misunderstood, a lot of folks think that founders themselves would be preferred shareholders because they're the founders, right? They sort of in a special class, and maybe that future employees or future hires or something would be the common stockholders. It's actually not typically the case. It's more commonly the case that that founders are indeed common stockholders, and future employees, lower hires, things like that, are also common stockholders, or they may be option holders, which we'll talk about in a minute. And it's actually the investors who sit in the preferred share class. Usually that share class is created at the time of investment. So an investor comes in and says, we want to invest in your company, and it's established enough to where we don't need to do this on a convertible note basis or something like that. Instead, we're basically going to buy stock in the company. And the reason that we often carve out a preferred share class is to give those investors a preferential payback treatment. So again, just using a made up example, if I'm an investor and I invest my $10,000 into that same startup, and I receive for that, based on the valuation of the company, I receive some pro rata number of shares. Those are going to be preferred shares. And what that means is, say at the end of a calendar year, the company has actually created profit and has dividends to pay back. Preferred shareholders at a basic level would typically receive back the value of their investment. So in my case, $10,000 first. And then after that, whatever percentage of shares I actually own, then I would participate pro rata in the profits of the company. So that's just a simple example. There are other preferred rights that investors can have when they invest and receive preferred shares, but those preferred rights are usually determined at the time of investment, and so they can be a little bit different on a per company basis.
Jan,
Yeah.
Before you get into options, we had a question around Delaware C Corp. And
looking at the chat, let's see, what do we have here?
So it's from Justin.
From Justin. Okay. Expand on the Delaware C Corp. Yeah. Okay, that's a great question, and it's one that I should probably always expect in these types of presentations. It's a good question. So let's pause real quick on the full investment side and talk at a foundational level about entity selection, just as an aside here. As a startup, you've got a lot of different options for running your business and your company. On day one, you don't have anything typically wrapped around your idea. You're just trying to build and just trying to get a proof of concept going and work towards an MVP or whatever your basis for success looks like. At some point, it probably makes sense to create some form of limited liability entity around your idea. And there's a whole host of reasons for doing that. Think of a limited liability entity like an LLC or a corporation as a bucket. And into that bucket kind of goes everything. You want to put your IP, your intellectual property, the things that you create around your idea, your branding, your marketing, your assets, all of that goes into the bucket. You also want to start capturing your debt and expenses in the bucket. So if you have purchased laptops for your team of 5, if you have started subscribing to cloud-based software to build things out, all of those types of expenses that are clearly related to the product and the idea you're building out, those should go in the bucket as well. So if you haven't set up an entity yet, it's a little bit harder to create that bucket because you're sort of manually doing it. You may, for example, be putting a lot of expenses on your personal credit card. That's not the end of the world. It's okay, but you'll want to account for those later on by journaling those expenses and either treating them as a loan to the company or through some other accounting mechanism to make sure that you get paid back. So the benefit of setting up a company is multifold. One, again, we refer to them as limited liability entities. That's a really important concept because as you build your company, and I hear this all the time in startup advising, I review pitches with startup founders, and so often we go through the normal pitch deck type concept. What's your product? What's your idea? Who are your competitors? What's your TAM, your total available market? Why do you think you're going to be successful? Why are you unique? Why is your team amazing? Why are you as a founder amazing and all that? And almost nobody addresses liability components. Nobody thinks through how much trouble they could actually be in for what they're trying to do. And that's okay. Maybe that's what lawyers are for. It's why we have jobs. But The nice thing about the limited liability entities is that when you build your company through an entity like that, you are availing yourself of that limited liability concept, which generally means, if you're doing everything right, if you do go out and make a big mistake and it turns out that your product was not great and it hurt someone or it created a lawsuit or liability, usually that means that only the assets and only the things that you've placed into that bucket, that limited liability bucket, could ever be at theoretical risk. They're not going to be able to pierce through that entity and come after you personally as a founder or your team or anything like that. So to Justin's question about why Delaware C Corps, well, Delaware C Corps are just another form of limited liability entity. The reason that you keep hearing about Delaware C Corps and that they're the chosen favorite among investors is because Delaware has the oldest and most robust and most well, designed statutory laws around investments in the country. And what that means for investors is they know what they're getting. So if you are a Delaware C Corp, the forms used to establish the company, create bylaws, create investment docs, securities filings, securities exemptions, which we'll talk about in a minute, all of that are really well-worn territory. Everybody knows what they're getting. VCs know what they're getting. Private equity groups know what they're getting. They all get it. Anything outside of the very traditional Delaware C Corp structure is possible still, and don't let anyone tell you it's not. You can absolutely raise investment through any other form of limited liability entity. In fact, some of Sacramento's best startups did not start out as Delaware C Corps actually, and still raised tons of money. And a lot of companies that I advise on come to me and they already have Delaware C Corp on the tip of their tongue. That's what they think they want to do. And I actually have at times talked some startups out of the Delaware C format because truly what they're trying to do and their long-term goals don't really revolve around third-party investment and traditional institutional investment like VCs, things like that. And really what they're trying to do is build sort of a small business and get it up and running. They're self-funded. They have some capital to do it. They're not looking to raise money. They just want something that's simple and easy to administer and operate and still have the limited liability protection. Those tend to be really good fits for LLC format. If you're in California, setting up an LLC is really easy. It's really easy to operate and run, far less formality than the corporate structure, far less filings, easier from a tax perspective because it's usually pass through. So the partners just receive income as individuals. And it's really good structure, and it gives you all the protection that you need. And you can 100% still go raise investment based on an LLC structure. You just might not be quite as enticing as an LLC to a venture capitalist or a private equity group. But keep in mind, some of the largest companies in the world are LLCs. So again, it's predictability and it's understandability for investors. That's why you keep hearing about the Delaware C Corp concept. I'm just looking real quick in the chat as well here. These are good questions too, and I'm going to answer these right now since they're so topical. The question is, can you please, or do companies need to register both Delaware and California if they live in California but do business only online and have no physical location? So that's a great question. And then there's a second one. So to that first question, the answer is that the super compliant answer is that if you are set up as a Delaware C Corp and you are, oh, sorry, I think I went off full screen there. You guys still have my screen?
Yep. Yes.
Okay. Great. The answer to the California registration question is you should. If you're based in California, meaning even if you don't have a physical storefront, but your founders are here, the only reason that you set up in Delaware is because you're a startup and you wanted to raise outside capital, you should still register in California. There's a whole host of reasons why. One, even if you're only online, if it turns out that you do run into some sort of legal question or trouble, someone's going to find out eventually that you're in California. And if you haven't registered in the state, you're losing your limited liability protection. You're really putting that at risk. And so for such a nominal amount of money and effort, I mean, it's $800 a year. I know that's a lot of money. Depending on where you're at as a startup, but it's a very small amount of money compared to the risk that you may be putting yourself at by not doing it. The other thing is, since we're here talking about investment, any investor that is worth anything if they see that you're operating in California, for example, you're meeting with them in California or something, and they don't see you registered in California, it's going to create major red flags for them. They're going to worry that you're a non-compliant company and you're cutting corners. So that's concerning. And finally, as we're going to talk about on a slide down the line here, part of the whole Delaware C Corp being really well-worn territory, investors know what they're getting. Part of the whole thing with California companies, so many of them are here, is that the California securities exemptions are really well known. And so registering in California is kind of again, it's a tried and true thing. So you set up as a Delaware C Corp, but you register as a foreign entity in California. You've checked those two boxes. Now you know exactly the roadmap that you'll need to, from an exemption standpoint, for securities filings to go and raise capital. So it's worth it. I would err on the side of registering in California, even if you're just online and you don't have a physical business. Maybe you don't need to do it immediately, but certainly before you talk to investors, and probably before too long. The other question that I saw in there was just about filing in Texas. I'll put it this way: nobody is going out of their way, investor-wise, to say go file in Texas. There's a great, huge, burgeoning startup community in Texas, especially in Austin, and some of those companies are filing in Texas. But Delaware is absolutely going to be the gold standard still for setting up for startup investment. And some of these other ones I'm going to wait to address later for private placements and things like that. We'll come back to those a little bit later. So let's see. We left off on options for the option contract side. So options are interesting. Options we often think of as an instrument available to employees or co-founders or somebody that maybe wasn't a day one founder. And they're very poorly understood, but the general concept is an option contract is giving somebody the ability to either purchase or vest into real shares, real equity down the line. Options are not equity. Options are the opportunity to receive equity down the line. So for example, if I join a company and they offer me a stock option package, and let's say that using normal startup terms, there is a 12-month cliff, meaning I don't even start vesting into my options until I've been there for a year. And then the vesting schedule beyond that 12-month cliff is a 4-year vesting schedule for my options. Typically what that means is at the end of 1 year, if I'm still there, the options granted to me, so let's just say there's 100 options granted to me. After that first year, I will usually receive 25 stock options. They'll be vested, and that means they're mine. And then usually on a monthly or quarterly basis thereafter, I will vest pro rata into the subsequent 75 options. So over the course of the following 3 years after that, I'll have fully vested into all 100 options. Okay, so good, I'm done. I made it 4 years, early stage company employee, and I've got my 100 options. What does it mean? And usually the answer to that is, in the event of a future investment raise, or certainly in the event of a merger or acquisition, some sort of liquidity event, meaning the company is raising cash or being purchased or acquired, I have an opportunity to exercise my options, and the company has to give me notice and the ability to do so. That's usually all designated by a stock option agreement. And the idea behind an option is you have a locked-in strike price. The strike price means that you get a suppressed lower value for purchasing the actual share. So let's say at the time of acquisition, I have my 100 options that are vested. I own those. They're not real shares yet. They're just the opportunity to buy shares. Let's say the option contract said I get to purchase those shares eventually at 10 cents a share. So $10, I could pay $10 to purchase the actual shares. At the time of exercise, the shares are actually worth $1 each. So the company is about to be acquired. I get to exercise my options right before that acquisition. I literally write a check to the company basically of $10. The company grants me a stock certificate for my 100 shares. And then the next day, my shares are worth $100. I basically have just made 90%, $90 on that option exercise, which is great. And if you certainly, if you expand that into much larger dollar figures, you can see why that's so enticing. There are some interesting tax consequences around stock options that are almost enough for a separate presentation, but that's the general concept. And a warrant is a somewhat related concept. A warrant typically gives an investor an opportunity to participate in a future investment round. the instrument basically lets them buy in at that round. It's a contractual concept that allows them to join, and it gives them that right. So they can hold on to this contract and basically say, I have a right to join in a future round at a particular, you can set an investment basis for it, but it's a little bit different than a safe note because a warrant technically doesn't require any investment upfront. It's just a contractual right to participate later. Let's see. All right, so we're still kind of sticking with the securities definitions here a little bit because they're really important. Anytime a company, regardless of whether it's large, publicly traded, or small, privately held company, which is most startups, proposes to use an instrumentality of the interstate commerce in order to issue securities, what that means is anything, literally using anything, especially the internet, the company as the issuer must register the offering publicly or find an exemption. And you can see that that's bold because it's really important. Registering with the SEC, which is what you would have to do, for example, for an IPO, for a public offering, any interaction that you have to have with the SEC is painful. Even as an attorney, it's painful. And it's an important regulatory body, but they're very complex. And the documents that you need to file to register are exceedingly difficult and always require legal counsel. I have never in my career met a non-attorney startup founder who can navigate SEC compliance and regulatory filings on their own. The good news is there are lots of exemptions to SEC filings. So the biggest ones that we tend to focus on for startups are 4A2 and Reg D. So number statutory private placement and regulatory safe harbor avenues that allow companies to sell securities without engaging in the lengthy and expensive process of public registration. And, and again, crowdfunding at the bottom there, that's Reg CF. But the idea here is that over time, there have been exemptions from the traditional securities registration requirements created specifically to allow smaller companies to actually raise funds and not have to comply with these very expensive obligations. Because if they had to comply, it would all but foreclose the opportunity of raising investment. The cost of raising money would be higher than the money that could be raised. So it doesn't make sense. And so in support of small businesses and the allowance of free market capitalism, these exemptions have been created. But like any other exemption, they're finite and they are very specific. So you need to fall within the guidelines in order to avail yourself of them. Hold on, I'm just moving my window around here. So Rule 506 transactions, otherwise known as the Regulation D safe harbor, are really important. These allow issuers, that's you, the startup, to raise an unlimited amount of capital, it's money, via the sale of unregistered securities under Section 4A2. That allows exempt fundraising for offerings of investment rounds of varied sizes that include the following. So unlimited number of accredited investors, which we'll talk about, and up to 35 non-accredited investors. These tend to be very important for safe rounds. Safe rounds tend to fall right into 4A2. The company is required to determine the level of sophistication of investors. This is really important. The company must reasonably believe that each non-accredited investor is sufficiently sophisticated and knowledgeable. And how do you do that? It's not just I talked to, Jeff over at StartupSac and he seemed sophisticated, so I think he's fine, he gets it. There's actually a little more documented process to this, and you need to actually generate and use forms. Luckily, there's a lot of templates out there, but basically non-accredited investor forms that ask a number of pre-structured important questions to gauge someone's sophistication, their liquidity, their comfort zone with investment, because ultimately, what the market and the SEC don't want to see occur is folks losing their shirt on startup investments. Startups are notorious for, I hate to say this, but over-marketing their worth and over-marketing their products and services. And the thought is that non-accredited investors may be more subject to those types of over-marketing efforts. And over-marketing is not a term of art. That is one step down from fraud. Non-accredited investors are at risk from overzealous founders that are trying to really go raise investment. And the fear is that if a non-accredited investor who doesn't have a ton of capital or liquidity goes and secures a second mortgage on their home to go invest in a startup, and that startup completely walks away and fails, now you've got an increasing number of private investors who don't have the financial comfort zone to actually lose that type of money. Because just like the stock market, investing in startups is a risky business. In fact, probably riskier. So the accredited determination is very important, and raising a round, if you're going to include non-accredited investors, which most startups do, you need to follow these exemption rules. I talked about no general advertising or solicitation. If you're now allowing non-accredited investors, that's accurate. Don't go post on Facebook, don't post on Twitter, don't go on LinkedIn, don't post anywhere that you are open for investment. That is a general solicitation, and it's a big no-no for the SEC. If you want to talk to investors and you want to find them, those conversations need to be more one-to-one, more targeted. If you go and give a pitch, this is a good example, actually. It's less applicable with COVID, but one day, if you go and give pitches again in person, be careful. Go and give your pitch, and it's fine to go say, we'd love to speak with investors, things like that. That's okay. Don't get up and say, we want to raise $1 million, so write your checks here. Don't talk about terms, don't talk about numbers, don't talk about anything like that. You're getting closer and closer to a general solicitation. Disclosure documents are really important. They are required with somewhat ambiguous requirements. Typically, with disclosure documents, what we're talking about is think of your pitch deck. Think of the way that you design a pitch deck, which is you're trying to promote your company. You're selling yourself and your product and your idea. And then go back and redo your pitch deck and view it through the lens of someone that wants to pick it apart, that wants to find everything that could conceivably go wrong with your company. Really take yourself out of your founder's shoes. Go be your, most pessimistic, negative Nancy self and pick it apart. Those things that you come up with are probably the things that we should put in disclosure documents. Here's why we think we're great, but also you should note that what we're talking about is incredibly dangerous. For example, our idea is to create the newest, most amazing flying hoverboard. We've all been talking about hoverboards. Back to the Future promised them. We really want them. We think they're cool, and we have the technology to do it. That's exciting. There's a very good chance that kids will be falling off these and breaking their necks within 6 months. There's a huge potential liability concern. There's insurance requirements. There are lawsuits likely impending even before we start launch. Those are the types of disclosures and considerations that you're going to want to start thinking about building into disclosure documents for investors. They need to be informed of those, and it can never be assumed that they'll come up with them on their own. And then finally, Form D needs to be filed with the SEC, and the corollary state law forms need to be filed. In California, again, it's a well-established exemption structure. You need attorneys almost always to help with this stuff. It is very complex, and getting it wrong is so much more expensive than paying attorneys to do this stuff. I know that sounds self-serving, but it's true. I don't know what the perfect ratio is, but I'm going to say it's 10 times more expensive to not use attorneys to get the stuff right than it is to come back later because you tried on your own and got it wrong. Let's see. Let's check the chat real quick just to see where we're at. What do we have? Jeff, that's not true. You've been described as sophisticated before. And Laura had made a good point, which is she sees options and warrants more frequently in A rounds rather than seed and pre-seed. Absolutely. That's a good point, Laura. We think of when you want to break out these investment types in terms of company stage, it's true. We tend to see promissory notes, convertible notes, and safe notes in very early seed stage, pre-seed and seed. And then beyond that, you start to get into real proper equity purchases and option agreements. Those tend to be more like Series A advanced rounds. And part of that is because they're much more complex and they're so expensive to structure. Again, it's like, don't go spend $100,000 raising $100,000, right? That doesn't help. The accredited investor definition, I'm not going to read through every single one of these, but the two most important ones to focus on, and by the way, these definitions do change over time, so worth considering that these are living, moving, breathing definitions, and they probably will be changed again in the next couple of years, I think. A natural person who has an individual net worth or joint net worth with their spouse that exceeds $1 million liquid at the time of purchase, or has assets under management of $1 million or above, excluding the value of their primary residence. That primary residence one is key. The SEC and the law generally don't want to see people leveraging their homes. There's so many policy reasons for that, but generally speaking, to be considered accredited and fall outside of the non-accreditation limitations on investment, you need to have a bunch of cash available. It can't be all tied up in securities, or it can be, but they need to be immediately, you need the ability to liquidate them immediately. They can't be tied up in investments that you can't touch. And the second one, a natural person with income exceeding 200,000 in each of the two most recent years, or joint income exceeding 300,000. Again, some of these numbers are going to change over time. And then some of the others might apply trust with assets, things like that for more institutional or larger family estate investors. Some of these really do make a huge difference for how you pursue investment at an early stage. A safe note round, you have to go through the accredited, non-accredited concept. It's really templated at this point. The forms are out there. Safe note exists. Accredited, non-accredited forms exist. They're all there. It's just a matter of administering them properly and making sure that you're checking the boxes and filing the right forms on time. But again, luckily, this process is so kind of figured out at this point that it's complex, but it's not rocket science, and it's not like you're creating the concept every single time. I talked a little bit about the disclosure things and how you might theoretically approach it from a pitch deck standpoint, but let's talk about some of the categories that you want to think through as a company. And again, I encourage all startup founders to think about their companies in terms of these categories. At a high level, offers made exclusively to accredited investors require only straightforward disclosures because it's assumed that accredited investors are more sophisticated and have the ability and the resources to evaluate a potentially risky investment. I don't actually find that to be true. And I don't find that just because someone is accredited by the definition that they are any more sophisticated than a non-accredited investor. But the law says, even if that's true, we're not as concerned because they apparently have a ton of cash available to them. Offers made to any non-accredited investors must include a fairly robust private placement memorandum, a PPM, that contains everything an issuer would generally need to include in a prospectus, which is a document used in a public filing. Usually you're going to want to include, and you see sort of why I talk a little bit in terms of a pitch deck, what's your market? What's your business? What do you do within that market? Do you have any material legal proceedings ongoing? Any risks, any pending litigation? Do you have a co-founder that's planning to sue you? Do you have a contract that's already gone bad? How are you capitalized? Where is the money? Do you have money? Are you currently do you already have investors from the past? How did you get to where you are? Your structure and management. So again, pitch deck, who's your team? Are they founders? Are they full-time employees? Who are your employees underneath them? Do you use independent contractors? Are there risks associated with that? And then broader risks, just in terms of market competition, liability concerns like the hoverboard concept, everything. And then financial data, that's going to be your P&L. If you've been operating for a couple of years, you may still be operating in the red and overall be showing losses, but showing your expenses, showing what it's cost to get you to that date is crucial. And then forward looking is usually, either a pro forma or some sort of projected analysis of finances. And then the overall analysis, is this, in conclusion, based on all of the above, is this actually a good investment opportunity? We keep coming back to non-accredited. It's a really important concept. The Rule 506 transactions, they allow for relying on non-accredited investors up to 35, but they are burdensome and expensive disclosures. So that PPM, that breakdown that I just described, it's a good idea, if not necessary, to hire counsel to put that together for you. And depending on the complexity of your company and your length of existence and the things that are going on, getting a good PPM in order can cost anywhere from $5,000 to $50,000. It just really depends on what is going on with your company. So it's burdensome and expensive. The issuer, meaning you, the company, bears the burden of proving investor sophistication. So you cannot just rely on somebody saying, I get it. You need to have the documentation and paper trail to demonstrate in the event of an audit that they are in fact sophisticated enough. And there's no general solicitation. So again, you can't go shop it around, that you have to be really one-to-one in your communications, which is more expensive and difficult to administer. I see the chat blinking at me. Let's see what's in here. Mariah, that's a good question about Form D and preparing for that. And your second comment couldn't be more true, that it's a very broken system, super broken system, or at least it's getting better. But filing and preparing Form D filings, it honestly, even for attorneys like me that work in the corporate investment world for so long, everyone, hates the day they have to deal with Form D. The good news is there are actually a few companies out there that do a shockingly good job in helping prepare them, but they are a bit complex. And no matter what, I mean, my most broad advice, again, is that you have to use counsel for it. You need to use particularly experienced counsel that do them regularly, because the guidelines around Form D and sort of the tricks of the trade are only going to be known by not just any attorney, but corporate investment attorneys that really get it. Not just to make a plug for them, but Douglas Bosley over at Witten Law Group, I mean, he's a staple of the Sacramento region startup investment world, and I would say knows as much or more about Reg D than anyone. My counterpart, Ryan Norman, who some of you know, and who I've co-founded a couple firms with, also an absolutely phenomenal resource on these things. And I'm up there as well, but Reg D is complex, and getting the filing prepared and actually accomplished. We corporate attorneys still rely on third parties sometimes to at least help with the filing, help with getting things done in a quick manner. The second question on there is I assume that this to be provided like in a table or in any other format. If that's referring to the PPMs typically follow more, you couldn't do it in a table. You could outline it in a table, that would be fine, but they generally tend to end up being extremely robust documents. They can be anywhere from 10 to 150 pages, and they are in narrative form a lot of the time. They're broken out in those categories, but the details provided are key. So they're usually in long narrative form, and that's why you need counsel to help put them together. Let's see. And Laura, how am I doing on time? I know we're getting close to 12:30.
Yeah, you've got about 35 minutes left. So.
Oh, okay, and we're going all the way to 1. Okay, awesome. Let's see. John had asked, how does this apply to friends and family? Okay, so John, that's a great question, and I wanted to talk about friends and family rounds because they are almost always non-accredited, with the exceptions that are. So the reality is, friends and family rounds, I personally still think should be raised via convertible or safe notes. That's the way to do it. It's so straightforward, and it's been done so many times. You still need counsel to help and get it right, but the fact is, John, and everyone else, you have, through the existing exemptions, you can raise from friends and family. And if you're a startup, a truly early stage startup, your disclosure forms, you don't need a full PPM. You just need a disclosure form, and it's probably not going to be that long. We've done safe rounds with disclosure forms that are as small as 2 to 3 pages. You just need to go through those categories and highlight those things. And here's the other thing. If you're raising, so let's say it's a pre-seed, it's a friends and family round, let's say it's $50,000 or $100,000. The reality is the SEC, they still want you to get all this stuff right, and you should, but it's impossible for the SEC to be going around auditing every $50,000 or $100,000 friends and family round that's raised. It's important to get this stuff right, and you should. And the other thing that I would say is, if you get it wrong or you don't do a good job of it, consider your next round you're raising that's proper Series A or something. Those investors will spend the time and money to go back and do due diligence and see what you've done in the past. And if you didn't check the boxes, red flag. So it's worth it. It's worth getting it right. From Laura, I've heard startups say if they had to do it all over again, they'd get an attorney involved earlier. Yeah, I agree with that. And Mariah shared the common offerings and accredited versus non-accredited. That's awesome. The passive versus active investors, that's a little more, okay, so the question is, can you speak to passive versus active investors? Yes. That's a slightly amorphous concept because it's not so much a legally defined difference. A passive investor, or an active investor rather, is going to be someone that often, think of like a strategic advisor investor, and some VC groups even are actually more active to the extent that they invest real money into your company, but they don't want to just go hands off. They also want to very closely watch what you do. So let's say they agree to invest $1 million in your company. They may not agree to write you that check all up front. In fact, they almost never will. They may write you those checks based on proven accounting. You're going to have to report to them. You're going to have to prove things up. They may even deploy a one-to-one advisor to your company to follow and watch what you're doing, who has essentially acts as the conduit between you and the investor. That's very active. That's like hand-holding, babysitting, staying on top of it, making sure that their dollars are working for them. A passive investor is the investor that usually more accredited, and there's plenty of them in Sacramento in the angel community, but the idea is that they hear about a company, they like the idea, they have seen the disclosure documents, but honestly, a lot of the time they're relying on the reputation of either the founders or another investor that's already come in. So for example, if a local venture capital group like Mineta Ventures wants to invest in a company, as a private investor, you probably feel pretty good about that vetting process that's already been done. So you might either be a limited partner in Moneda's fund, meaning you're super passive, Moneda's doing all the work, you're just writing a check to them and hoping that they, give you a return on that. Or you're an angel that says, I get it, Moneda's in, everyone else is in, local reputable investors are in. I don't really need to know more, and I don't need to handle this, and I don't have time. So here's my check, go make money, go make us all money, and that's it. So a little bit of a different model, there's sort of broad categories. Let's see. Oh, also, I think I want to make sure I didn't lose my my ability to see the chat window. There we go. Let's see. In terms of, we're going to go through these other slides a little quicker. In terms of reading term sheets, this is the model term sheet from NVCA. I highly recommend, I've got some resources at the end of this whole thing, but I highly recommend looking up NVCA. Phenomenal resources for startups and for investors on both sides of the table. In fact, the leading resource, for startups and for raising investment. Every single bullet point that you see on here is an entirely separate presentation and is going to be a huge point of discussion with your attorney when you're talking about raising capital. And there are so many things to consider. Again, liquidation preference, that's like the preferred shares concept we talked about, dividends, how people are paid out based on the equity that they hold, voting rights. So if I invest into your company and I end up owning 40% of the shares in the company, what voting rights do I have? Do I get to control the company at all or not? Protective provisions. So can we protect against those voting rights, or can we protect both the investor and the company? Anti-dilution provisions. So if I want to buy 10% of your company, I want 10%. I don't want 10% today and 6.5% later. How can we protect me from being diluted in the event of future investment? Conversion rights, again, that's more like convertible note considerations. Registration and information rights that we've talked about. Follow-on rights, similar to drag along at the bottom. The idea is if I've already invested into a company and I don't have dilution protection, I invested and I bought 10% of the company, and later on others are going to invest, therefore diluting my position. Do I have follow-on rights to, I can write a check, but I can keep my 10%. Basically, everyone's agreed that I can lock in 10% as long as I keep writing checks to match up the new investment. And then rights of first refusal, ROFR, the concept is basically, will you give existing investors the right to invest in the next round first prior to going outside of them? So lots to consider there. Surviving due diligence is painful. I don't care what any investor tells you, it's usually pretty painful for the company, and it's almost never easy. And again, I recommend that folks have counsel for it. It's pretty difficult to go through due diligence on your own without some sort of dedicated employee or consultant or attorney to help along with it. And I would, at the point of going through real due diligence, hopefully that means that you're doing well enough to actually afford this, but you should have counsel and sophisticated finance advisors. They don't need to be employees, but a CPA or a group that regularly goes through diligence and understands the process. Because diligence can take months, sometimes longer, and they are going to, a good investment group is going to tear you apart. They're going to rip the mat out from your front door. They're going to mash down the door. They're going to go through every room in your proverbial startup house and flip over all the furniture. They're going to pull the beds, apart and go through the drawers. That's it. I mean, they're going to look through every nook and cranny to find out if there's anything hidden or that they should know about that you haven't disclosed yet. If you haven't disclosed it, they're going to try to find it. And even after they've done all of that and flipped your startup house over and gone through everything and teased out the various issues, and their counsels teased out the various issues, if they decide to invest, they're going to have you sign a really complex, lengthy investment document that says, even if we didn't find anything, you're going to indemnify us for it, and it's going to come out of the investment funds that we promised you. So let's put it this way. The power is on the investor side, and that is particularly true if you're a Delaware C Corp. That's why they want you to be that. It's not to protect you, the startup, so much. It's more to protect them. And that said, I don't want to make the investment process sound more adversarial than it needs to be. At the end of the day, a good investment opportunity is one where all sides, yes, see the opportunity to make money and create commercial value together, but also a good investor believes in the company, truly believes in it, not just from a profit standpoint, but actually wants to support the company and really see it grow, and is willing to do the things that the company needs to grow rather than just try to cut costs and get to profit as quickly as possible. So, but those categories that you see on the slide, those are going to be the primary ones that you're going to have to go through in a diligence process to actually answer questions on. And then, so you've gone through this whole process, they flipped your home over and you're just finished putting your rugs back together and you're, fixing everything that they've broken and feeling like you've been all too invaded. And they say, okay, we think we're good. We're going to write you this check. We're going to invest. We've gone through the term sheets. You know what the terms are. We're going to write you a $10 million check right now for 10% of your incredible $100 million company. And you're just happy to be done with diligence. And you think, that's great, write the check. I need a break. And then, you think you're done, but you're not. They're now living with you. The house that they just flipped over, they now live in one of the bedrooms upstairs. And what that means is they're going to deploy, depending on the sophistication of the investment group, and this goes back to Mariah's point about active investors, they're all active to some degree. It's just a question of how it feels to you as the startup. They're all going to deploy some sort of advisory group, some sort of board. They're going to seek and get seats on your corporate board. That may give them decision-making powers, it may not, but it's certainly going to give them advisory rights and rights to view everything that the company does. So they're going to get management rights, maybe. They're always going to get information rights, meaning you can't hide anything from your investors. If you do, you are certainly breaching a fiduciary duty. You will be in trouble. And protective provisions for both the company and the investors. Again, we talked a little bit about follow-ons and approvals, deal participants, so they can follow on later on. If you're a Series A investor and then the company's going to do a Series B later on, you may have a right of first refusal to participate in that Series B based on the terms. If you decline that opportunity, you still sit as an investor and an equity holder, but say it just doesn't make sense. You don't have the capital ready to deploy. That's fine. They give you the opportunity to evaluate the investment first. And if you decline, or the time lapses in which you had an opportunity to accept that opportunity, they go outside and they go raise with different parties. However, the approvals component of that is important because if you were an earlier stage investor, you may have approval and denial rights over subsequent investors. Usually those rights are going to be determined by who is a majority owner of the company. Sometimes those rights are unanimous, meaning everyone needs to agree to add a particular type of investor or accept a particular investment threshold. So investments up to a certain amount, the company can do without additional approvals from other smaller investors, but anything over a certain amount requires everyone's approval, things like that. And then derivative actions, those are fun. Derivative action is, hey, startup, even though you made a bunch of representations to us and we went through diligence and we thought we knew everything about it, turns out we found out something under one of these rugs that we didn't check before. And it seems like you weren't all, forthright and truthful with us. So now we're bringing a derivative action, which is a shareholder lawsuit against the company. It happens all the time. Luckily, you will not be dealing with that, right? Because you'll have hired counsel and you'll have gone through this process and been very transparent, and you'll have gotten your ducks in a row so that you'll never have this problem down the line. All right, we're pretty much at the end here. I do, all these slides are going to be available through StartupSac later on, so don't worry about, taking screenshots or anything yet. They'll be available, but these are just some good resources for you to take a look at. Brad Feld's book is fantastic, continues to be a good guiding resource for venture deals. Startup Law blog is awesome. I think all of these are still up and running at the moment, but I actually recently, on doing a domain check on some of these, I feel like they might have moved around. But in any event, search around, lots of good references out there. The legal doc side is amazing. Oryx and Cooley's are phenomenal. Like, even as an attorney, I appreciate what they've put together. Doesn't mean I always use them, but as a reference, they're great. And as a startup, I would say, don't go look at those forms thinking, oh, Oric and Cooley created them, so now I don't need an attorney because they're just there, right? Just all I need is a signature on the line. It doesn't work like that. But I do recommend startups go read through them. Go look at the docs that are that Oric and Cooley are putting out. They have basically created a startup investment doc package that is, I would argue, the most streamlined bare minimum you might ever need. And you'll see in me saying that there's still hundreds of pages of complex legalese to work through. So that's saying something. Those are some of the best law firms in the world putting those together. Very worthwhile reading through and getting a sense of what some of these docs look like, but you're going to need counsel eventually to really do this. That's me. There's my contact. Feel free to reach out, JM at Outside Legal. That is .legal. It's not outsidelegal.com. And let me take a look back at the chat here. Laura posted NVCA. That's good. Model term sheet download. Yes, which is solid. And an accountant for due diligence. Amazing. Yeah, if there's any other questions, certainly feel free to throw them in the chat. I don't know, Laura, is everyone muted? Maybe, possibly.
Actually, we could go now to have people ask their own questions, but if you would just raise your Zoom hand, I believe if you go to the participants box, you can see that, and then I'll call on you so that we don't have 10 people asking a question at the same time. This
Surely
is really...
there can't be any questions after after all that.
Yeah, I'm sure there are some questions. Oh, Mariah says, amazing summary. Yeah.
I'm sure anyone here who's given a presentation can appreciate this. It's always hard to boil down these things into something digestible, but that's the goal. It really is the goal. And as Laura knows well, and anyone in the Sacramento startup community knows well, I really do respond to emails. I know that this format and this forum might not feel perfect for Q&A. And if you have a really specific question for your company, I'm pretty good about responding to things. I'm not going to give deep legal advising through email to companies that aren't clients, but I'm always happy to advise and give a general sense of a concept.
I have a question while others get warmed up. You talked about friends and family a little bit, and you said, that's where you're going to be doing your convertible note, or maybe your safe, something like that. So those forms of investment don't require you to be a qualified investor. Did I misunderstand that?
So, okay, so the accredited investor status, and actually here, let's see if I can go back a little bit. We're going to go to the 506 section here. So the answer to that question is I'm always going to recommend that you go seek accredited investors. But the fact is that's usually not possible at a very small stage. And friends and family are often not accredited. The good news is Section 4A2, that's the one that so many California startups are relying on. And it's just really well-worn territory in terms of raising. And even if you're raising via convertible note or safe note, you can absolutely do so with non-accredited investors, up to 35. That's usually more than enough to get done what you're trying to get done in your seed round. All this really requires is the Form D filing and the corollary state law form filing. And, I always find myself saying this, but I don't want to say it as an attorney, that you can still raise these funds without filing those forms. If they're not compliant, and it's, it may not be the case that the SEC is going to show up at your front door knocking because you raised a very small amount of money without filing all the right forms. The thing is, again, it's so possible to do it. And again, let's say you're raising $100,000, I feel like that's a pretty, substantive friends and family, small seed round to kind of get you up and going. If you're trying to bring $100,000 on, two things. One, if it's going to cost you a few $1,000s to get these forms filed properly and kind of get your safe notes in effect, isn't that well worth it to check the box and know that you're right? Two, by not doing any of this, what are you really representing to your investors? I mean, these are the people that are believing in you to do this right and spend their money wisely, and you're already starting off on the wrong foot, which is not being compliant. And so the answer really, Laura, is you can have non-accredited, but you need to inform them. The disclosure docs are not that bad, but you got to get it right. You got to just be really honest and truthful with them. Ryan and I always say, err on the side of a little more conservative caution. And that way, if someone hears all that and says, all right, I appreciate your transparency on it. That number one, that tells them that you're trying to get it right. It tells them that you're not just foolish and loosely believing in your idea without being realistic. So that's actually a good thing. If after hearing all that, they've had a chance to digest it and they still invest, you're covered. You're good. They're not accredited, but you have checked the box saying that they are sufficiently knowledgeable and have been educated on what the risks of investment are. That's all you need to do. And then filing the forms is really quite straightforward.
Okay, so Mehdi has a question and then Valerie.
Yeah.
Hey, Jan, thank you for your presentation. I'm Mehdi, an entrepreneur, early stage entrepreneur. And back to what you said, you talked about your bucket, you put everything in the bucket, and then you claim the expenses. So right now I'm bootstrapping and I'm not relying on any outside sources. Just wondering how sophisticated the process is if I rely on my own credit card to pay the costs and then write them off when I need to do the taxation.
Yeah. Okay. And I have to give Mehdi a shout out too, because this is not my first time talking with him, and he is working on a very cool idea in a very cool company, and he is the epitome of a startup founder. So if you have questions as a very early stage founder, reach out to him because he's got cool ideas going. But to that question, it's a great one on accounting. So here's what I would say. If you're using a personal credit card, and if it's not quite the right time to set up that corporate entity or something, because it's costly and it's a bit of regulatory filings and this and that. So right now you're just bootstrapping, you're putting it on your personal card. Here's what I would recommend. Every credit card under the sun and every accounting, software that you can use is ultimately going to allow you to generate a report, right, of your expenditures. What I recommend startups do, so this doesn't become too onerous later on, is on a monthly basis. You don't need to do it daily, but on a monthly basis, generate your credit card statement, go through it. Hopefully you can generate it as an Excel report. That's even better. And flag those expenses that truly were related to the business. Or even if you think, I'm not entirely sure, it was like a lunch with another founder or something like that, or you bought a new laptop that was probably way nicer than you technically needed, flag them. Go ahead and flag them for the company. And what you're going to do is you're going to create basically a list. You can delete all the other ones. All you want really are those lists of expenses that were for the company. Depending on what you do at the next tax filing time, so your calendar year filing for the following year, let's say you did this throughout 2020, and here we are in 2021, taxes are coming up due soon. Let's say you still haven't formed that entity, but you have incurred all those expenses. I would recommend talking to a CPA or an accountant about how to journal or capture those, because if you're still thinking of forming the entity, your answer on that may be a bit different than if you've decided at this point you're not going to go forward with the idea, but you incurred all these costs. In either situation, your CPA or accountant is more than likely going to be able to help find a way to write those off as business expenses. It may require that you, if you're not going to form that entity, it may require that you at least go do a simple sole proprietor filing to create, either an EIN or some sort of basis to capture those, to say, look, I'm not a corporate entity, but I am a sole proprietor conducting a business enterprise, and I did incur these costs in good faith in trying to do this. There's always a way to do it. It again, just like the legal services, it probably costs less to talk to somebody about how to do it on the accounting and CPA side than it does to not do it and sort of guess at it. But usually, if you've incurred a cost in good faith for the business purpose, you'll probably be able to take some sort of deduction.
So Jan, I'm the proxy for asking Valerie's question. I guess her microphone's not working and Laura's dog is barking, so she can't ask it. Valerie asks, you briefly mentioned crowdfunding. Are there any specific SEC requirements after, say, a successful Kickstarter campaign?
Yeah, so Reg CF is the, which stands for crowdfunding, is the operative body of laws around that. The cool thing about crowdfunding is they really went out of their way, the SEC that is, and even states have kind of gone out of their way to recognize that crowdfunding is this very unique vehicle for investment, and it's quite different than even non-accredited seed type investment, because with crowdfunding, you're not typically raising large sums of money from any given individual, with the promise of profit down the line. You're often raising small sums of money with the promise of a product delivery or service delivery. And so in recognition that the entire concept is a bit different, Reg CF, and there's some case law around it and things like that, but I would say that it's pretty navigable by non-attorneys. That's the cool thing about Kickstarter and some of the other platforms out there. They have really good resources. That's why I don't cover it that much in this presentation, because those resources are really well defined within those platforms. They'll tell you all of the admonitions and all of the sort of red flag things and things for you to know and consider as a company looking to raise through crowdfunding. I would go look at Kickstarter's pages for companies, because they're all on there, and they're good. They're really well built out. They've all been created by attorneys. And Reg CF is the big one, but rather than focus on just what the SEC has said, which can be complex and confusing, go look at the crowdfunding platforms and see what they have. And if you're, it's, again, every company is different. If you see something that you think isn't right for you or you're concerned about complying with, that's when you should reach out to an attorney.
Thanks. I think Jeff Sakala has the next question. Jeff, do you want to unmute and ask the question?
Sure, thanks. So, hi, Jan. My question is around mixing some of these investment types. If, say, you get an offer for a convertible note and also maybe want to do crowdfunding or, Reg D, is there any issues that arise with mixing different vehicles?
Yeah, so there are a couple of things. One is I would not recommend trying to raise, in those various forms all at the same time. And the reason for that is you don't know what the outcome of any given campaign is going to be. So that makes it almost necessarily impossible to make material commitments to investors. For example, in a disclosure document for a private placement memorandum, if you are essentially telling investors that here's us, here's the company, here's how we're doing to date, here are our risks and all that sort of stuff, and we're hoping to raise our first $1 million, and we intend to, in the term sheet, we basically intend to raise at XYZ terms, and simultaneously you have a crowdfunding campaign going that becomes wildly successful and takes off. Number one, you might not even want to move forward with that private round, and which is problematic because now you've made commitments to investors. And number two is the term sheet commitments may be materially different because you've actually raised funds on the side. Now, the second component of that is, okay, I get it, Jan, we're not trying to do it all at once, but what if we want to do one then the other? That's okay. Let's say you started life as a startup with a crowdfunding round. You have a product, you wanted to get it out there, you threw it on Kickstarter, it worked, you raised $150,000 through it, and you launched some products, and that was a great way to get the company kind of up and marketed. Not necessarily problematic at all for a future round. In fact, maybe it may even be a great thing. If I would say it's less likely to have a huge impact. The only thing that in that example, raising like a crowdfunded round, the bigger concerns wouldn't so much be with foreclosing a future investment opportunity because you had already raised a crowdfunding round. It would probably be more about the diligence aspect for those private investors saying, all right, you did this crowdfunding thing. How's it going? Have you delivered on it? If you did deliver, what's your product again? Are we concerned that the provision of those products through the crowdfunding round is going to create unforeseen liability that we don't even know about yet? That's the only potential downside, I think, is creating the potential for additional questions and diligence concerns. But otherwise, there's not a reason that you can't kind of do one than the other. And the only other thing that I would say is keep in mind, costs drive a lot of this. Crowdfunding is very cheap, very easy to kind of get on one of these platforms, create your marketing materials, throw it up there, see if anybody bites. Convertible notes, and particularly safe notes, because it's well-worn territory, pretty easy to kind of get a good attorney to help put those together and do it. A full-on private placement, which is typically reserved for kind of larger investors, but maybe not all the way to venture or private equity, just more expensive, larger documentation required, larger disclosures, more sophisticated due diligence than you would get with just a friends and family round. So those costs drive a lot of it. They end up sort of organically matching with the amount of money you're raising.
Awesome,
Okay.
thanks. Oh, you on, Laura?
I'm back. Yeah, Balboa's shut up for a minute
okay,
here.
cool.
Yeah. So any more questions before we move into wrap up?
There is one from Alex.
Uh-oh.
Okay.
What type of liability insurance all online businesses should buy to make sure they're safe? Ooh, that's a good one. I'm glad to see that question. Because startups tend to be underinsured. And the answer to that question is it does depend on the types of services that you're offering. And truly, I mean, depending on if you're offering a product or service or you're just a SaaS play or something like that. Here's what I'll say. Rounds yet? Laura, that sounds like angry investors over there. Even if you're not raising a full round yet, but you are starting to operate, you've got an online business, you're trying to take on money, you're trying to take on contracts. Many of your, the people and the clients or the customers on the other side, especially if they're sophisticated or you're working B2B, something like that, they're going to ask that you have insurance of some type. And so it's almost at an early stage is as much checking the box as about specific coverage that you end up needing for it. There are a ton of insurance providers out there that focus just on startups, and they're going to offer usually aggregate. Here's what I'd say. You're always going to want a policy that has an aggregate coverage in it of at least $1 million and usually a per incident coverage of at least $500,000. Those sound like big numbers, but all you're paying is a small premium to get there. So it's pretty affordable, and kind of like the legal services, I would say it's worth your whatever, $100 a month, if that's probably less than that, to go and secure that. Because again, having the coverage is really nice, especially if you have the limited liability entity up. If you've got your limited liability entity and your insurance coverage, you're very unlikely to be risking any of your personal assets or anything like that. So that's good. And it's worth the expense. And again, it's kind of the same as the attorney thing. Spend that little bit of money up front to avoid the big expense later on. Looks like, oh, from Mady, there you go. Yeah, I mean, if that's all we have for questions, Laura, you may be good for wrap.
I think so, yeah.